Let's get a conversation going now. We have Nilesh Shetty of Quantum Advisors joining us now to discuss the markets. Nilesh, good morning and thanks a lot for joining us. This is Pavitra. You know, just a while ago on the show, we were discussing how on the one hand, we have all of these recession fears, we're talking about inflation, but on the other hand, you're seeing this momentum just continue. So how would you look at it now and how do you think the Indian market is positioned? Do you see a big upside still?
Yeah, the recession fears is primarily for the Western markets. Nobody talks of recession in India. The worry is, does it slow down the pace of growth in India? But by and large, people are still forecasting very aggressive growth for GDP in India. So in that environment, India still remains an outlier and an economic bright spot in the world, which is what you're seeing in the kind of flows that have come in over the last month in India. So again, we believe, given where valuations are, which are slightly at a slightly higher level than the long-term averages, and given that Indian equity earnings after a 7-year decline from 2013 to 2020, where equity earnings barely grew, you are seeing now at a 4-5-year upcycle. And in that environment, it is unlikely that the Indian equities do not deliver decent returns. Despite the rally over the last 2 months, we expect the next 2 years to be very strong for Indian equities. And we expect equity markets to deliver returns in line with their long-term averages or slightly above that over the next 3-4 years.
Okay, hi Nilesh, good speaking to you. Thanks so much for joining in. Well, you know, there was all these unlocked trades that were playing out. And if you got it right, you made big money. What's your view on them from here, though? Because, you know, some of these hotel stocks have gone flying away. You know, select aviation stocks as well have done well. Interglobe, by the way, has a bit of an overhang out there because one of the promoter entities are selling out. How do you approach this space? Do you think the best is behind? Or do you think there is still some more headroom, particularly for hotel stocks, because you'll have occupancies going up. The average room rent as well is moving up. I think all of us are feeling the brunt as well. Your take?
Yeah, I mean, the portfolio follows a value style. So for us to buy into these companies was around that lockdown environment where they were trading at sharp discounts to their net asset value. After that, given the rally that is unfolded, and again, what tends to happen is people extrapolate near-term earnings and assume that is perpetuity, which is not the case. So at least for us, a lot of these companies are expensively valued. We've exited our hospitality holdings that we had in the portfolio. On the aviation side, we've never been convinced of the aviation story. It's a great macro story. But again, it's so easy to add supply into this market that anytime an incumbent has decent kind of market positioning, you will have new players coming in. So it doesn't allow sustainable earnings to be made in the sector. So we've never had exposure per se in the sector over the last almost 15 or almost 12 years now. So again, it's a great macro story, but given the state of balance sheet and given how easy supply is to be added to the sector, we've never been convinced of the aviation story.
I don't disagree with you, Nilesh. Morning. What about IT? I mean, today, of course, stocks are doing well, but overall, do you think it's a good contra play right now?
Yeah, so we trimmed a lot of our IT holdings last year in the rally, but after the correction, where most of these names are now down 40-50% from their peaks, it is getting interesting for us. And we've started adding some of the names a little bit into the portfolio. Again, the fear is the slowdown in the West will affect them, but we've seen historically it slows down their growth rate, but doesn't materially impact their rate of growth. So they may go from 15% growth to about 11-12% growth, but which is still fairly good enough at the valuation that they're trading. Again, these are very high cash generating companies, very great free cash flow yields. So for us, yes, they are now getting interesting and we are adding them bit by bit into the portfolio.
Nilesh, anything else you feel like, you know, at a time like this might be a good space to get into or a safe place to put some money?
Yeah, for us, the largest allocation still remains financials. I think they've not materially participated in the post-COVID rally, and most of them are trading at discount to their long-term averages. So we've added some private sector banks. The second largest weight remains consumer discretionary, and within that, two-wheelers. We still think there is room for these stocks to move higher. Volumes are still to recover, and most of these companies are sharply below their peak volumes. So I think if the volumes come back, and we assume as the GDP progresses and the price hike that these companies took gets absorbed in the market, you will see companies getting back to their long-term averages or long-term volume numbers. We think given where valuations are, you might see some upside there as well. So these are the two large bets in the portfolio right now.
All right, Nilesh, the sector that's really come back in style has been the cement space. In the last 1 week or so, the street is factoring in everything. Price hikes, demand comes back, consolidation, you name it. Street believes that there is a lot of action out there. What's your take? How do you approach this space? Would you take some money off the table, or do you believe the best is yet to come? And if you particularly have a view on ACC and Ambuja Cements, because both those two didn't do much for the last few years, but they're doing plenty in the last 2 months.
Yes, I will not be able to comment on stocks, but we have exited our cement holdings. Again, one is valuations, where we think a lot of the good news is already priced in. We are slightly, again, it's a commodity stock, and you tend to play cycles of commodities. So you sell it when the assumption is the best of the scenarios will play out over the next few years, and valuations start factoring that. And then we wait patiently for sort of bad news to come in and people getting disappointed. So our view right now is that a lot of the good news is already priced in, and we have exited most of our cement holdings in the last 2 months, actually.
Okay, you've exited most of your cement holdings. What do you think of the auto pack? There seem to be a lot of trigger aheads, the raw material costs coming off, the semiconductor issue sort of easing a little bit. But of course, a lot of these stocks have already run up quite a bit as well. Do you think they're attractive even at these prices?
Yeah, so I mean, these stocks were large underperformers in 2020, 21. And this year, this calendar year, you've seen some sort of improvement. But even then, valuations are still far below their historical averages. So we still believe there is upside in these companies. The only thing is volumes need to come back to the kind of volumes that they were delivering before 2020. So far, they are still below that. And if volumes come back, we expect these companies to move materially higher from current levels.
All right, Nilesh, thanks very much for joining in and for your thoughts on the market.